again, India is, as I mentioned to you, one of the largest telecom markets in the world. However, it's a very, very competitive market. The average revenue per minute is 43 paisa, which is, half a rupee. In terms of pounds, I can't even calculate. It's like 0.5% of 1%.
0.05
yeah.
pounds.
And what has also happened is that there is one large player, the other side of Reliance, which has entered this industry recently. It has huge pockets. They have committed to spending or investing almost $40 billion. And because they are a new entrant, obviously the pricing is very competitive. So in the near term, pricing is an issue. It's an industry where you have to constantly invest. So you had 2G, then you went into 3G, now you have 4G. So technology, you just have to keep on investing. So I think for the next maybe a year or so, it's going to be a very, very competitive market. But the way even Indians are taking to data, I think there's a lot of potential for that market.
I'll just add that the fact that Vodafone is willing to put billions of dollars, they also believe in the long-term prospect of what is going to be, and no one is willing to lose the ground, including our other sibling Reliance. So they are a new entrant. They have put $25 billion. Vodafone has put $25-30 billion because they all are convinced that whoever survives will really make so much money that this effort and the risk will be worth its while. On your question to the amount of money which is moving away from gold and property, I showed a slide in my presentation just to recapture. We are $2 trillion overall financial saving of anywhere between $450 to $500 billion annually. Investment in equity is 2.5% versus investment in property of 55%. Investment in gold is 10%, and investment in bank deposit is 15%. Even some of the not lesser known countries like Peru will have much significant portion of their financial saving invested in equity. The reason, because people made so much money in real estate, because it was, as I said, some of it was black money, and the real estate prices got fueled up because all that money was going up. Hence, there was a lot of concentration to invest money there. But we have seen last 3-4 years, these are not earning returns. So, if it is, let's say 10% of the financial saving gets invested in equities, which is still will be much lower than the world average and even the emerging market average, we'll be talking of $50 billion of local money going into equity markets every year, just in terms of perspective. And that's what keeps us excited, because we believe that the best days for our business are not behind, but they are ahead.
Frankly, it's the first time in all our lives that demonetization has happened. So
of this magnitude, even though it happened in 1978, it was 0.4% of GDP. This time around, it's 14% of GDP.
So roughly $200 billion plus worth of notes will be demonetized. Now there are various estimates that out of this, almost 25% will be cancelled. So people who own it will not be in a position to deposit it because they will face penalties and criminal action.
Up to 25%.
Yeah. So if that happens, it's a straight bounty for the government. That money can then be used for development activities like infrastructure, where India needs a lot of money. More importantly, apart from this one time, what this has done is it has sort of shaken people who are not complying with the laws. And it would be it would take a really brave man now to continue with these kind of evasion going forward. There's a lot of scare from people who have been, doing or undertaking tax evasion. What it also does is that, Mr. Modi has been talking a lot. Frankly, last 1 year, there has been a little bit of question mark that whether it's only talk, no walk. I think with the last 3 months of reforms, with GST and then now with the demonetization, everything he says is now 100% taken that it will be done. So I think from a longer term perspective, the impact of GST and more tax compliance would mean that you will have much more stronger government coffers than ever. Our tax to GDP ratio is 10%, which is one of the lowest in the world. Even if it goes up to 13-14%, frankly, we'll have 0% fiscal deficit. So the long-term implications are huge. How it will impact, as I said, it's the first time of such magnitude that's happened, but the spending of government on infrastructure definitely looks to be going up, and we believe that anything to do with capital expenditure and infrastructure building eventually will have a big upturn. What it will also do, just to take forward from the lady's question, is that it will move money away from physical savings into organized financial savings. So, well-capitalized banks with a big retail network, asset management companies, life insurance companies, they should all benefit from higher flows.
And part of this is already reflected in the market. So a lot of good companies have come down 20-25% in the last 10 days, while the index is down 10%. So we have 7 million investors back home. So what we are aggressively advising them, that no one knows the bottom. You can keep waiting that next 3 months will be bad, hence markets will go down, but no one will be able to catch the bottom. So why don't you systematically invest? So basically, SIP is a very good form of investment in our funds, and we are aggressively pushing that. So the people who are uncertain here also about some of these things can also adopt that approach, that we will systematically invest over the next few months. If there is a volatility, we will be able to capture that. So I think the future is quite bright. The government is very committed to have a blend. So right now, the energy blend which is coming from renewable energy is less than 5% in our overall energy basket. So the government is quite committed to take that number to 15% over the next 5 years. And they are doing whatever they can, including providing some incentives for putting up wind farms and solar farms. There is some depreciation benefit which was been announced in the last budget to accelerate this business. The other part is, interest rates from the peak have already fallen by 200-250 bips in the last 3 years. And with whatever is happening because of demonetization, because so much money is there in the banking system, we are expecting interest rates to fall by another 100 to 125 bips over the next 12 to 18 months. So 75% of the financing of lots of these projects is done in the debt side. So if you have 3% absolute fall in interest, you have 9% incremental ROE on your equity. So that makes it much more viable than it was 3 years back. Third big thing which is happening is, the cost of per megawatt is going down. So we had solar 5 years back at maybe $2 million per megawatt. Now it is at less than $1 million. So there is going to be a tipping point when this business will become really viable and you will have huge scalability. And we are very aligned. We will capture it at the right time in the right format. We will stay away from businesses which are likely to be impacted, like real estate clearly is one business which will be volatile and which will be challenging. So you will not find possibly a real estate company in our portfolio. A lot of high discretionary brand, like someone like Louis Vuitton, may struggle for next 1 year in India, because if it was mostly done on a cash basis. So a lot of these businesses will get impacted, and we are very watchful about it while constituting our portfolio.
Just one point on that, the very obvious names have already corrected. Markets are very dynamic. So now it's a question of whether it's in the price. So there might be some businesses which are going to be impacted next 3 months, but maybe the prices are more than discounting the impact. So suppose if you are bullish on, say, cement, for example, as a sector, because of the huge growth in housing and the infrastructure development, and the prices have already corrected because of the near-term issues, maybe that might be an opportunity. So I think it's more what is discounted rather than what is the near-term impact. I think that is what is going to direct.
Like Sunil made a case for United Spirits. We do not believe that people who have the habit of drinking will stop drinking just because they do not have cash and they have to pay by credit card. Whoever has to drink will drink. Maybe it will impact for the next few months that people will get used to buying these drinks on a credit card. But I don't think people will stop drinking. So if, let's say, United Spirits falls because the next few months are challenging from their financial perspective, and next 1 or 2 quarter results are going to be bad, we think it will be a great opportunity, and that's where my point of risk versus volatility. So this is the volatility, we recognize it and we take advantage of it. We don't think it's a long-term risk.
Sure. So I'll take the easier question. Though it's not easy.
I'm more worried about the key man risk on these two than the government, actually. Yeah.
So on the valuation perspective, I think Madhu had a slide. So we are right now trending at roughly 15.5 times 1 year forward, which is the 10-year average. The high we have gone is 28 times, and the low we have gone is just below 10 times in 2008. But roughly, India has been trading at between 15 to 16 times on a 10-year basis, and which is where we are right now. The only thing is we believe that earnings can surprise going forward. Obviously, this demonetization is going to impact the next quarter earnings, but it can impact positively going forward because everyone is building a case of high interest rates, but the interest rates fall has surprised everyone. And we believe that there is a case of 100 basis point cut more between now to December and 17 as far as the repo rates are concerned. In fact, after Trump, India is one of the very few or maybe the only country where interest rates, the GSEC yields have fallen. Every other country in the world, the GSEC yields have gone up. In terms of the first question, frankly, it's a 10 sigma event. It's an event where you can't model in. Our view would be that these kind of events may happen. There's a 0.1% probability it might happen. But because you have a fear of that thing which is maybe a 10 sigma event, if you don't invest, there's a big chance of you missing out on the growth. The other thing is, India is a democracy. And we have seen the history of the countries globally that a proper democracy has laws, has systems, and life goes on. I don't know.
I'll just add, I think what is most interesting is Mr. Modi is building India as an institution. So he is building policies which will hopefully last much beyond him. Is the work finished? The work is not finished. But whether we have come a significant way in that work in the last 3 years, the answer is a decisive yes. So God forbid that should not happen. But if that was to happen, obviously there will be volatility in the markets in the short term. But in the long run, we adjust to everything. When Rajiv Gandhi died in 1988, we thought the world has come to an end. But we had Narendra Modi after 25 years. I think the government is taking number of steps. Obviously, they are much more cognizable of the fact than even us that they need to create jobs. And those jobs will happen in number of sectors. And they have number of initiatives, like you had a Mudra Bank, which was being launched last year to promote entrepreneurship across board and to provide facility to small-time entrepreneurs at cheaper rate. So I think you will have a lot of jobs being created on the infrastructure, on the Make in India program, even on the services side. So if the economy grows to $6 or $8 trillion, obviously it cannot go without people. So you will have loss of jobs in one sector, but at the same time, there will be an opportunity on the other sector. Like, for instance, there are a host of new jobs being created in the logistics business. So there will be some loss somewhere, but people like Amazon or future groups are employing 20 times more people or 30 times more people than they're employing just for the delivery purpose in the last 2 years. So you will have the shift in the composition of job. But is it a worry right now? Yes, it is a worry. But will that remain a worry in due course of time? I think government will address that. So one of the biggest risks is Modi himself. As someone said, something were to happen to him. And that is in terms of, like as Sunil said, it's a 0.1% probability. But it is a risk because what he has initiated, it is one of its own kind, and that gets to finish. 70–80% of that is done in the last 3 years, but it's still lot pending for the next 2 years. Okay. The other thing is, because of this demonetization, let's say the verdict from the people is not yet out, and it has hurt a lot of people on the ground. So we don't know if there is any negative political repercussion which is there of this move as yet, even though a lot of polls which are being conducted in the last 10 days are not proving that it's a big political risk. A lot of people have liked it. 84% of the poll done by 84% of the responded who responded to a poll of Times of India actually voted very positively for this move. But that could be another fallout. Third is, you have elections like in UP and 4 other states. BJP has to win 1 or 2 of these elections for this reform momentum to actually accelerate. So those are the things which are there as a risk. If you believe that the bond yield worldwide will rise by 200 basis points, there will be a lot of turbulence across the world, and it will impact flows even in India. So that is a near-term risk clearly there. The other thing is, oil prices, if you believe, can go from $50 to $150. That's a big risk because we are, as Sunil said, we are a very large consumer of oil. But again, please don't take me otherwise. I have seen people focusing a lot on these risks. And obviously at one point of there's not been a period in last 25 years of my investing career where I could not list down 10 risks which are there over the next 1 year. The only one thing which we have learned is that if we buy right companies, if we buy right businesses, the time risk might be there, but if there is a tremendous margin of safety, this macro risk actually plays on its own, and good companies continue to do well. So like say, we gave an example of Divi's Lab being 150 times. I have seen a lot of times the stock going to 50% correction because of something or the other happened in a macro fund. But over a period of time, because it's a great company and it gets keep compounding money at 15, 20, 25%, it comes up. So frankly, while we track all these things, while we want to be knowledgeable about it, but when we are investing, we are not paying as much attention to these things as we are paying attention to what the company is doing, what the growth prospects of the company is, what are the longer term fundamental, and who is the entrepreneur. If we find these opportunities, then we systematically invest and we take advantage of a lot of these global factors or local factors which impact temporarily. And that's where our concept of volatility versus risk comes in. So I think the debt will also do well. As we said that interest rates are likely to fall by 100 bips. So if you are investing in a 30-year treasury bond or a 10-year treasury bond, and even this is not linear, even if you have a 80 bips reflection in a 10-year treasury bond, you could make 8% return, and you are making 7% currently. So your return in the government bond itself could be 13, 14, 15%, which is very, very high and very lucrative. So that is also a bullish picture, at least for the next 12, 18 months, since our call on the interest rate is very favorable. And if this interest rate plays out, as I said, the businesses which are funded largely by debt, whether it is a power plant, whether it is a alternate energy, where there is a debt component is very high, those are the businesses which will benefit a lot, and the ROE of those companies will go up considerably after they take advantage of the lower interest rate.
Obviously, as is the case with all the other countries, India is a large importer of goods from China. As far as the relationship with China is concerned, it's been a love-hate relationship. However, recently, there has been a lot of effort from both the sides to improve relationship. Having said that, I think India is focusing a lot on making in India, on trying to see what can be manufactured in India, including defense, which is again a big import item, electronics. So the second biggest import after oil for India is electronics. And the way the growth in import is happening, maybe electronics would become the #1 import for India. So there's a lot of focus in India itself in manufacturing in India. And I think that would lead to a better sort of a trade balance vis-a-vis China rather than what it is today.
A lot of political formats in which both the prime ministers have come, they have spoken, our prime minister has spoken, there is an urgent need to balance this trade. So we might, while we might continue to import from India, we would like the Chinese market also be opened up, where we can export a lot of things. So there's been a lot of talk of pharmaceuticals being exported out of India, and that market is not yet opened by China. So there will be some balancing of trade between India and China over the next 5 years. It will be combination of both. So they are obviously listing down businesses which can easily be manufactured in India. I gave an example of tear gas. There is no merit of importing tear gas from any country. So one is, why is it being happening? Because there are not proper policies, there are not proper incentives. In some cases, technology is lacking. In some cases, long-term stability for policy has been lacking. So the government will do its bit. On the other hand, there will be a lot of demand pull which will come up, because when we go from $2 to $4 trillion of GDP over the next few years, composition of a lot of businesses will change. So those businesses, there will be a lot of compelling opportunity to capture to those businesses, and they will be manufactured in India.
And there is a concept called offset clause. So for large imports, recently India tied up with Rafale to supply fighter planes. A part of the contract says that at least 30% of it has to be manufactured in India. So it's a combination of some forced manufacturing in India and some because of the huge market, like mobile phones. It's now one of the largest mobile phone consumers in the world. There is no reason why some portion of it cannot be manufactured in India. So it will be a combination of both of these. And obviously, as you said, a lot of reduction in the bureaucracy. So the effort from India is, as far as the ease of doing business is concerned, to go from the 136th country in the world to below 70. That's the target of the government.
That has been very volatile to honestly expect, and if I were to list the risk factors about India, so this is one of the real imminent risk factors, because there has been a lot of cross-border firing which is happening from both the sides, and because we are really clamping down on terrorism, so the other side is also taking a posture. But I hope sense will prevail and it will not escalate further from here, but that clearly remains one of the risks in the near term.
So in fact, if you actually go through the rules and regulations, I think India is one of the most liberalized country. We have FDI allowed in almost all the sectors to the extent of 49 to 100%. Even in some sectors which was considered to be sensitive, like defense, Modi government has increased FDI even in defense sector to the extent of 49%. So it's a much more liberalized country, and in fact the laws are much more lenient than a lot of other countries in the world. Even in retail, multi-brand retail is allowed majority. Single brand is allowed in a majority. Multi-brand is allowed in a minority, but it is opening up. So life insurance company, for example, we have already had the limit increased from 26% to 49%. Defense, which was a sensitive sector, the limit is 49%. In private banks, technically 98% of the private banks can be owned by foreigners. So it's a very, very liberal environment right now.
But in spite of that, obviously the flows have not been correspondent with the policy because of obviously red tapeism, bureaucracy, black money, corruption, and now those issues are also getting addressed. So hopefully the flows will accelerate in years to come.
So, the world is in a disruptive environment. It's not only in technology, even in brick and mortar businesses like retail, for example, technology has been a big disruption. So I think we are cognizant of the fact, and at all points of time, I think it's our day-to-day job to analyze, to sort of visualize what can be the impact. So I think we are very, very cognizant of that fact, and for each of the companies which we analyze, disruption is now becoming a key factor to keep in mind.
But we always keep the time frame in mind, because if I get worried that Tesla is going to manufacture cars which is not going to have diesel engines, but that may happen 20 years down the line. But in the meantime, over the next 2-3 years, we may miss on a lot of opportunities. So when we think of disruption, time frame is very important in our mind. So we are investors in some auto ancillary companies. Obviously, eventually if Tesla is very successful, it will impact the auto ancillary business. But if I get nervous about it, so the disruption is actually everywhere. So I will not be able to buy anything. So when we think of disruption, it is there in top of our mind, but we think of time frame.
Tim, did you?
Just to finish on a lighter note, the anti-corruption laws seem not to have come to the English cricket team this morning. So could you please accelerate that process?
Yeah.
And the second point is, if it comes to a serious Brexit situation, could you assure that we are at the front of the queue for all future negotiations?
Thank you.
I will take both the messages, and I will communicate to our Prime Minister that this was the only hindrance for money to come in India. I hope he will address it. Thank you.
Thank you very much, gentlemen.